Okay, let's dive right in. Welcome to a brand new explainer video on the Gap Advisor's Ind AS Clinic YouTube channel. I am so thrilled to have you here today. In this explainer, we're doing a complete case study teardown. We're breaking down a major financial reporting misstep that might just be hiding in plain sight, and we're going to look closely at how accounting rules are actually applied, and sometimes completely misapplied, in the real world.
Now, before we get to the heavy lifting, let's quickly set our baseline parameters. Just remember that the views expressed here are strictly the personal views of the author and are not binding on the audience. We always request that you seek the help of an expert before taking any action or refraining from any action based on what we discussed today. Also, for our financial context, the functional and presentation currency is the Indian rupee, or INR. So, any foreign currency is simply a currency that isn't the Indian rupee. And finally, our timeline follows the standard reporting period, beginning on the 1st of April and ending on the 31st of March.
Here is our agenda for today. 1. Welcome and the observation. 2. Unpacking Ind AS 109 rules. 3. Amortized cost and loss allowance. 4. The RBI draft directions. 5. Identifying prior period errors. And 6. Gap Advisor's Ind AS resources. Section 1. Welcome and the observation, a suo motu discovery.
So, this observation isn't just some theoretical textbook example. We actually found this on a suo motu basis, meaning we took the initiative to independently download and review the published Ind AS financial statements of a listed company. And what we found was pretty surprising. Take a look at their exact wording here. They explicitly claim that as a matter of prudence, they are delaying income recognition. They're stating they'll only recognize it as and when received or on an accrual basis when the expected realization is higher than the outstanding loan.
To an untrained ear, or maybe an investor who's just skimming the notes, this sounds perfectly reasonable, right? I mean, prudence sounds financially conservative. It sounds incredibly safe. But the critical question we have to ask is, does this illusion of prudence actually comply with the rigorous requirements of the Indian accounting standards?
Section 2. Unpacking Ind AS 109 rules, the reality check.
Let's hold that company policy up against the actual rulebook, Ind AS 109. You can see the glaring contrast right here. The company wants to lean on prudence to wait until cash is actually received. But Ind AS 109, specifically paragraph 5.4.1, is crystal clear. It mandates calculating interest revenue by applying the effective interest rate to the amortized cost of the financial asset once it becomes credit impaired. It absolutely does not give a free pass for prudence. It gives you a specific mathematical formula that must be followed.
Section 3. Amortized cost and loss allowance. The math behind the rules.
To truly grasp why the company's argument falls apart, we need to look at the math built into the standard. Appendix A of Ind AS 109 defines amortized cost as the initial measurement minus principal repayments plus or minus cumulative amortization. But here is the absolute crucial element, the part you literally cannot ignore. It's adjusted for any loss allowance.
So think about the step-by-step reality here. The company's argument simply doesn't hold ground. If a company legitimately doesn't expect to receive interest on a credit-impaired loan, well, it means they haven't recognized enough of a loss allowance. If you claim you expect zero interest, you mathematically must recognize a 100% loss allowance on that asset. And if you do that, it forces your amortized cost to zero anyway. And what's the interest on a zero amortized cost? It's zero. The math resolves the issue automatically without needing to invent a new policy.
And this brilliantly illustrates the bottom line. By delaying income recognition under the guise of prudence, instead of just properly adjusting their loss allowance, this listed company has simply failed to comply with the mandated requirements of Ind AS 109.
Section 4. The RBI draft directions. The plot twist.
Shockingly, this isn't an isolated incident. Even a public sector NBFC, one that actually won an ICI Financial Reporting Excellence Award, made this exact same mistake. But the landscape is shifting radically. The Reserve Bank of India has issued draft directions for 2025, which are slated to come into effect on April 1, 2027.
Now here's what's fascinating. Paragraph 83 of these RBI draft directions perfectly mirrors paragraph 5.411 of Ind AS 109. It explicitly states that banks shall apply the original effective interest rate to the amortized cost in subsequent reporting periods. This means that once this goes live, even the banks will be strictly forced to recognize this interest on credit-impaired loans.
Section 5. Identifying prior period errors. The warning.
This brings us to a massive warning for the industry. Non-compliant NBFCs are setting a huge trap for themselves right now. Look at Ind AS 8, paragraph 7. It clearly dictates that when an Ind AS specifically applies to a transaction, the accounting policy applied must be determined by that standard. Because Ind AS 109 already applies to them, NBFCs cannot invent an arbitrary policy of prudence to override it.
Auditors and investors, listen very closely to this. When the RBI rules kick in for banks in 2027, the banks will legitimately report a change in accounting policy. I am absolutely sure non-compliant NBFCs are going to try to mimic the banks and claim they're changing their policy too. Do not be fooled. For banks, it's a policy change. But for NBFCs, who should have been following Ind AS 109 all along, it's actually the rectification of a prior period error.
You must be incredibly vigilant about this. Beware of misleading disclosures in the future financial statements of NBFCs. They might try to dress up an error correction as a simple policy update, and you need to catch that.
Section 6. GAAP Advisors Ind AS Resources, your solution. Navigating all this is complex, but you don't have to do it alone. This very observation was actually featured in the 203rd edition of the GAAP Advisors Task Weekly newsletter authored by C.A. Manish C. Iyer. We've published over 230 editions on LinkedIn, which you can subscribe to for free. Also, any person can register for free at gapadvisors.com to access a massive repository of over 4,500 issues and responses on Indian accounting standards and Indian GAAP. You can even submit your own issues for a detailed response delivered straight to your inbox, which is incredibly useful for auditors documenting how they addressed an issue. And crucially, if you want your financial statements reviewed by GAAP Advisors before signing them, submit the near-to-publishing PDF to info@gapadvisors.com. This is fantastic for investors too, helping you make proper decisions on buying, holding, or selling shares. Finally, you can book a one-on-one consultation on your Ind AS and IFRS issues directly with the author from his topmade.io page.
Before we wrap up, I want to leave you with a provocative thought. Ask yourself, are you absolutely certain the financial statements you are analyzing or signing off on are truly Ind AS compliant? Don't let the illusion of prudence trick you into accepting non-compliance. Look at the math.
Thank you so much for your time today. If you found this explainer video valuable, please drop a like, add your thoughts in the comments, and subscribe to the GAAP Advisors Ind AS Clinic channel if you haven't already. We really want to spread the knowledge of Indian accounting standards, so please share this video with your contacts, colleagues, audit and finance teams, and students pursuing their CA course. Make sure to follow the GAAP Advisors Ind AS Clinic channel on WhatsApp for instant updates on all our new explainer videos, podcasts, newsletters, and newly issued standards. And if you want a complete deep dive into this observation, connect to our podcast available on Spotify, Amazon, or YouTube. Until next time, stay curious and keep learning.